should you pay down your mortgage or should you put money into your 401k more quickly? Which one, if you have extra dollars, which one should you do, more of, right? On the one hand, if you get rid of the mortgage payment, you've got more dollars to do things with. You're getting rid of that interest payment. On the other hand, if you put money in your 401k, you're getting a return and the compounding of that return. Which one is better? Is it better to do either of these things before you retire? And this is definitely on the minds of people who are getting close to retirement. So in this video, I'm going to give you some reasons for why some people pay off their mortgage and reasons why people put more money in their 401k. Spoiler alert, there's not a black and white answer as with many things in financial planning. The good news is towards the end of this video, I'm going to give you some guidelines that if you ask these questions, it will get you pretty close to knowing what's right for you. Hey everybody, I'm Nick Davis, founder of Brindle Bay Wealth Management, and I'm here to show you how to retire with calmness and clarity. I have a lot of messages that come out on a regular basis, and the only way I can make sure that you get those messages is if you hit that subscribe button and that little bell that notifies you every time something comes out. It also helps the channel when you do that, so thank you for that. So when you're thinking about this question of where to direct these dollars, it's difficult because there are good things about both of them. I mean, there's some pros and cons to asking the one question, should I put more money in my 401k? Then there's pros and cons to asking the other question, should I pay down my mortgage more quickly? So for example, if should I pay down my mortgage? Well, if I pay down my mortgage more quickly, I'm getting a guaranteed rate of return because I'm getting rid of that interest. Most importantly, I'm reducing my stress and increasing my happiness. And that goes a long way, knowing that that is taken care of. And I'm freeing up that cash to save somewhere else and do other things with that money. On the downside, though, is, what if I need to ask the bank to borrow that money back for a loan? What if I want to make some kind of big purchase and I don't have that cash to do that? And the big one is, where am I missing opportunity? Could I get more of a return on my 401k than I can get on my paying off my mortgage with those dollars? Now, if you ask the other question, which is, should I put more money in my 401k? You've got the pros of probably going to get a better rate of return over a long period of time, going to allow for more years of those benefits, meaning paying off your house is a one-time thing. Yes, you get the benefits of not having that liability, but having money in investments longer, year after year after year, you've got this compounding effect on that. So, maybe it's a one-time return to get rid of that interest, whereas it's a compounding effect to get returns in your 401k. But the downside is that, you still have that liability hanging over your head by not paying that mortgage down, and, that can take away from your happiness. You also need a longer time horizon with your 401k because you really can't trust a 3-year window or a 5-year window, really. With equities and 401ks, they tend to do better when you have a bigger window of time. So you really want to, consider that as well. And one that you may not understand right away when I say it, but I'll explain it, is investment income is harder to obtain than paying off your house. So here's an example of what I mean. So let's say that your mortgage is $1,500 per month, and that's $18,000 a year. Well, if you pay off your house, now you immediately have $18,000 that you can spend and invest and do whatever you want to do with, right? On the flip side, if you want your investments to generate that $18,000 a year to pay for that mortgage, how much money do you have to have in investments to do that? Well, if you're limiting your withdrawals to 4 or 5%, well, that means for every $100,000 you have saved, you're taking $4,000 to $5,000 out per year. So that means that you would need $300,000 to $500,000 saved inside of your investments to generate the income to cover your mortgage. What's easier? Yeah, it's easier to get rid of your expense and reduce your overhead than it is to create income from investments. But see, this still seems confusing, right? There's pros and cons to both. It doesn't give you any clear direction. So let me give you some guidelines that you can use to get yourself closer to knowing the answer for you. But first, let me also say that it is a great goal to have your house paid off before you retire, because there's an emotional factor there, and there's just a sense of pride knowing that you finally got rid of this mortgage after all of these years. It's always advisable to try to do that, but I see a good amount of people that do go into retirement with a mortgage. And that's okay if they're going to have a mortgage long-term in retirement, as long as their cash flow can handle it. All right, a few guidelines. Will my house be paid off through my normal income before or soon after I retire? If that's the case, then you're all set, right? No need to really do too much there. The next question would be am I adequately funded for retirement? So if you're on track to adequately fund your retirement and you have extra dollars, well then, of course, put those extra dollars towards paying off your mortgage. Will paying those extra dollars towards my mortgage hinder my financial plan? So what I mean by that is, if you're going to take money from other investments, is that going to trigger a tax? If you're going to take money from other investments, is that going to hinder your retirement plan? So don't pay off your mortgage and then not be able to generate income in your retirement plan. So consider that. Do I have 6 months emergency savings in my bank account? Of course, if you don't have 6 months emergency savings, do that first. Do I have 1 to 3 year goals to fund? So what that means is, are you going to make some major purchases? Are you going to want to buy a new truck, remodel your kitchen, things that you're going to turn around and say, well, I need to go get a loan, or I need to take money out of my income generating plan to do that? You should write down all those big expenses. You don't want to trust the market with 1, 2, and 3 year types of returns. So make a list of all those things that you're going to do within 1 to 3 years. Do I have MPI, mortgage protection insurance? Well, if you have MPI, of course, use dollars to get your mortgage to have 20% equity in your house so that you can get rid of that extra cost of that insurance. And would it significantly increase my happiness or decrease my stress? This is a cornerstone question. This is an emotional question. It's nice when the math and the emotions are the same thing. However, it puts a lot of weight into the answer if you're sleeping better at night, you're enjoying that sense of pride, being able to pay that off, as long as you're not hurting the other part of your financial plan. I give a lot of credit to how you just feel emotionally about wanting to pay that off. So what about you? What factors are influencing you in this decision? I'm sure I missed some. I'm sure that there's some that are more important to you. Let me know in the comments. Hey everybody, thanks for watching. If you'd like to see the way that we help people to create calmness and clarity for their next chapter of life, take a look at us at brindleandbay.com. Again, thanks for watching the videos. Please remember to subscribe, hit that notification bell so that you are notified every time a new video comes out.